Hi everybody, and welcome back to video number 3 in chapter 18. And when we left off, we were looking at the second part of this solution for the HUD example to record income taxes here for 2026. So the income tax expense is going to be the $100,000, and the deferred tax asset is going to be the credit of $10,000, and income taxes payable will be a credit of $90,000. So I think that's pretty straightforward and very similar to the Chelsea example. So the financial effect then is going to be as follows. Here's an example of the Hunt Company income statement with its revenues, and this is at the end of 2025, and it has income tax before income taxes of $450,000, but its current income tax expense is going to be $100,000, and it has deferred income tax of $10,000. So its income tax expense then is $90,000. For a total net income of $360,000. Okay, the entry then to record income taxes at the end of 2021 reduces deferred, I think they meant 2025 here, reduces deferred tax asset by $10,000. All right, let's take a look at another example. This time, the SARS has a deductible temporary difference of $1 million at the end of 2025, and that's related to the lifetime warranty of its products. This is its first year of operations. Its tax rate is 20%. SARS has $900,000 of income taxes payable. So the question, what is the journal entry to record income tax expense, income taxes payable, and the deferred tax asset? Well, in this case, to record those items, our income tax expense is going to be $700,000. And we get that income tax expense by taking our income taxes payable less the increase in deferred tax asset. So that's going to be $900,000 minus $200,000, or $700,000. And so we're going to debit income tax expense for $700,000. We're going to debit deferred tax asset. That's going to be the $1 million times 20%, or $200,000, and credit income taxes payable for $900,000. Okay, so if we continue with that example, after careful review of all the available evidence, SARS determines that it is more likely than not that it will not realize $80,000 of this deferred tax asset. What is the journal entry, if any, to record a valuation allowance for SARS's deferred tax asset? Well, we are going to record that as a reduction in the deferred tax asset value by debiting here income tax expense for an additional $80,000, and we'll credit an allowance to reduce the deferred tax asset to its expected realizable value, and we'll credit that for $80,000. Okay, and then on the balance sheet, we're going to present that as follows. We have the deferred tax asset of $200,000 less the allowance to reduce the deferred tax asset to its expected realizable value of $80,000, and that results in our deferred tax asset net of $120,000. All right, let's put it into practice here and apply the tax fundamentals. Wisco Company has the following information related to taxes in 2025. 1. Deferred tax liability, January 1, 2025 of $40,000. 2. Deferred tax asset, January 1, 2025, $0. 3. Taxable income for 2025 of $190,000. 4. Pre-tax financial income for 2025 of $400,000. And 5. Cumulative temporary difference at December 31, 2025, given rise to future taxable amounts, $480,000. And then 6. Cumulative temporary difference at December 31, 2025, giving rise to future deductible amounts, $70,000. And the tax rate for all years, 20%. The company is expected to operate profitably in the future, number 8. Okay, now they want several things. Alpha here, compute the income taxes payable for 2025. So let's jump ahead. And here we're going to start with our taxable income of $190,000 times the enacted tax rate of 20%. That gives us income taxes payable of $38,000. And Bravo here wants us to prepare the journal entry to record income tax expense, deferred income taxes, and income taxes payable for 2025. And what we'll do here is we're going to first determine the deferred tax asset and liability and the change in the deferred tax asset and liability in 2025. And so in number 5, in the previous slide, we had future taxable amount of $480,000, but in item 6, we had deductible amounts of $70,000. So our totals were $410,000. Using our tax rate at 20%, we had a $96,000 tax liability here and a deferred tax asset of $14,000 here. Okay. Now under Charlie, they want you to prepare the income tax expense section of the income statement for 2025, beginning with the line income before income taxes. So if we look at that, here is the income before income taxes, $400,000. Our income tax expense, current, which was $38,000. Our deferred income tax of $42,000. So our total income tax expense is $80,000 with net income of $320,000. And as part of Bravo, there was a change going back. There was a change. Here we had the deferred tax liability at the end of 2025, the tax liability at the beginning of 2025, and the deferred tax expense for 2025, increase required in deferred tax liability at $56,000. And then we have deferred tax asset at the end of 2025 of $14,000. There was zero deferred tax asset at the beginning. So there was a deferred tax benefit of $14,000, requiring an increase in the deferred tax asset of $14,000. Then for income tax expense, we started with $38,000. We had deferred tax expense here that increased the deferred tax liability of $56,000. We had the deferred tax benefit for 2025 that increased the deferred tax asset of $14,000, and the net deferred tax expense for 2025 was $42,000, resulting in an $80,000 income tax expense for 2025. And then our income tax expense, we debited for $80,000. Deferred tax asset, we debited for $14,000. Income taxes payable, we credited for $38,000 with a $56,000 deferred tax liability. And that was part of the numbers here in Bravo. Okay, so we just did Charlie. So, here, and now if we go back for our delta here, WSCO examines the available evidence and concludes that it is more likely than not that the 30% of the deferred tax asset will not be realized. And they want you to prepare the journal entry to record an allowance if needed. So here, we're going to record that allowance by taking the income tax expense of $4,200 as a debit, and then we credit the allowance to reduce deferred tax asset to expected value, expected realizable value, and that's $14,000 times 30%, which is $4,200. And the allowance account is reported as a contra asset to the deferred tax asset. Okay, contra asset here for that allowance. Okay, in our next section here, we're going to identify additional issues in accounting for income taxes. And there are specific differences here. Numerous items create differences between pre-tax financial income and taxable income, as I'm sure you're somewhat aware. For purposes of accounting recognition, these differences are 1, temporary, and 2, permanent. Temporary differences are temporary differences that will result in taxable amounts in future years when the related assets are recovered. So, deductible temporary differences are temporary differences that will result in deductible amounts in future years when the related book liabilities are settled. Okay. So, accounting for income taxes. Temporary differences. Here, taxable temporary differences result in deferred tax liabilities. Deductible temporary differences result in deferred tax assets. Okay. So, there are a number of deferred tax liability situation, and here are some temporary differences that result in deferred tax liability. This looks like a good place for us to stop this video, and when we return, we'll be taking a look at those in a little more detail. Until that time, bye for now.